A single text message. Dude, I owe you big time. Come over one day after work, and I'm opening a bottle of Bollinger. That text wasn't about a birthday gift or a sports bet. It was a banker thanking his colleague for manipulating a global interest rate. The favor he was thanking him for? Stealing potentially billions of dollars from ordinary people like you. Your mortgage payment, your student loan interest, your credit card rate. All of them were rigged by a handful of traders sending messages like this. This is the story of the biggest financial scandal you've probably never heard of. Imagine discovering that every time you made a mortgage payment, a tiny fraction of it was being skimmed off by bankers at the world's largest financial institutions. Not through some sophisticated algorithm or complex derivative. Through text messages, instant messages, casual conversations over coffee. Can you put in a high fix today? I need it at 5:36. Done. No problem. And just like that, trillions of dollars in financial contracts worldwide were manipulated. This is the LIBOR scandal, the London Interbank Offered Rate. For decades, it was the most important number in global finance. It affected $350 trillion worth of financial products. Credit cards, mortgages, student loans, corporate debt, derivatives, municipal bonds. If it involved borrowing money, LIBOR touched it, and it was all a lie. Between 2005 and 2012, traders at the world's biggest banks Barclays, UBS, Deutsche Bank, JP Morgan Chase, Citigroup, Royal Bank of Scotland manipulated LIBOR for profit. They did it openly. They joked about it. They celebrated it. And when they got caught, the fines totaled over $9 billion. But here's what nobody talks about. That's just what the banks paid. The actual cost to regular people, to pension funds, to small businesses, to anyone who borrowed money during those years. We'll never know the true number. Today, we're exposing how a system trusted by the entire global financial system became the biggest price-fixing scheme in history. Let me explain what LIBOR actually was, because understanding this is crucial. Every morning at 11 a.m. London time, a panel of the world's biggest banks would submit a number. That number represented the answer to one simple question. At what interest rate could you borrow money from other banks today? The British Bankers Association would take these submissions, throw out the highest and lowest few, and average the rest. That average became LIBOR. It was published daily in multiple currencies and for multiple time periods. There was a 3-month US dollar LIBOR, a 6-month Euro LIBOR, and so on. This number then became the benchmark for virtually everything in global finance. Your adjustable rate mortgage? Probably LIBOR plus 2%. Your student loan? LIBOR plus 3%. A city's municipal bonds? LIBOR plus 1.5%. Banks used it to price hundreds of trillions in derivatives. Corporations used it to calculate their debt payments. Governments used it to set borrowing costs. It was everywhere. And here's the critical part. It was based entirely on honor. There was no verification, no audit, no checking if the numbers banks submitted were real. The system assumed these institutions would tell the truth. They assumed wrong. LIBOR wasn't based on actual transactions. It was based on estimates. Each bank was essentially saying, if we were to borrow money today, we think we'd pay this rate. Notice the language. Think and if. Not, we did borrow at this rate, but we think we could. It was a survey masquerading as hard data, and the entire global financial system built itself on top of it. Think about that for a moment. Trillions of dollars in real financial contracts affecting billions of real people, based on what bankers said they thought interest rates might be, not what rates actually were, what they guessed they might be. It's like basing your entire diet on what people say they weigh, not what they actually weigh, and then being shocked when everyone lies. So how did they manipulate it? Let's walk through a real example from the evidence that came out in court cases. It's 2008. A derivatives trader at UBS has a massive position in interest rate swaps. If LIBOR goes up even a tiny amount, say 0.01%, he makes millions. If it goes down, he loses millions. So he sends an instant message to the colleague at his own bank who's responsible for submitting UBS's LIBOR number. Can you keep the 3-month dollar LIBOR as low as possible today? I'm short 3 billion. The submitter responds, sure, no problem. The next morning, UBS submits an artificially low number, combined with submissions from other banks whose traders were also playing this game. LIBOR comes in lower than it should. The trader makes his profit. Job done. The favor gets returned the next week. Different trader, different direction. I need it higher. Done. They didn't even try to hide it. Here are actual messages recovered from internal bank systems. Dude, I owe you big time. Come over one day after work and I'm opening a bottle of Bollinger. Done for you, big boy. I'll pay you $50,000, $100,000, whatever you want. I'm begging you, keep it low. If you do that, I'll fucking do one humongous deal with you, like a $50,000 deal, whatever you want. They treated it like a game, a favor between colleagues. They celebrated successful manipulations with champagne and cash. One trader offered another a Ferrari. But it wasn't just individual traders working within their own banks. They colluded across institutions. Traders at Barclays would contact traders at Deutsche Bank, who'd talk to traders at JP Morgan, coordinating their submissions to move LIBOR in their favor. They used Bloomberg chat rooms. They used WhatsApp. They met for drinks after work and discussed it openly. The conspiracy wasn't sophisticated. It was brazen. And it worked. For years. During the 2008 financial crisis, the manipulation took on a different flavor. Banks were submitting artificially low LIBOR rates not to help traders, but to hide how desperate they were. See, if a bank submitted a high LIBOR number, it signaled they were having trouble borrowing money, that they might be in trouble. During a financial crisis, that signal could trigger a bank run. So banks submitted rates that made them look healthier than they were. Barclays got caught doing this. Their defense? Everyone else was doing it too. We just didn't want to look bad by comparison. Imagine that defense in any other context. Yes, officer, I was speeding, but everyone else was also speeding, so I sped too to blend in. Now let's talk about who got hurt, because this isn't an abstract crime. Real people paid real money. Start with homeowners. Millions of people worldwide had adjustable rate mortgages tied to LIBOR. When banks manipulated LIBOR higher, those homeowners paid more in interest than they should have. Every month. For years. A study estimated that from 2005 to 2008, when LIBOR was being manipulated upward to help trader profits, American homeowners with LIBOR-based mortgages overpaid by approximately $6 billion. That's not the high estimate, that's the conservative one. State and local governments got hammered. They issued bonds tied to LIBOR to fund schools, hospitals, infrastructure. When LIBOR was artificially high, taxpayers paid more to service that debt. A single county in Alabama filed for bankruptcy partly because of interest rate swaps tied to manipulated LIBOR rates. A hospital system in Pennsylvania paid tens of millions more than it should have. Pension funds lost billions. These funds had invested in complex derivatives to hedge their risks. But those derivatives were priced off LIBOR. When LIBOR was manipulated, the hedge didn't work as intended. Pensioners, people who worked their entire lives expecting a secure retirement, saw their benefits cut because the math underlying their pension funds' investments was rigged. Small businesses that took out loans tied to LIBOR paid more in interest than market rates should have dictated. Some went under. Jobs were lost. Lives were upended. And here's the cruelest part. When LIBOR was manipulated lower during the financial crisis to make banks look healthier, savers got destroyed. Money market funds, savings accounts, any investment that paid returns based on LIBOR paid out less than they should have. Retirees living on fixed income saw their interest payments drop because banks were lying about rates to protect their reputations. So homeowners got squeezed when rates were manipulated high. Savers got squeezed when rates were manipulated low. The banks profited from both directions. Let me tell you about one specific victim. A municipal water utility in Baltimore had borrowed money through bonds tied to LIBOR. They were a non-profit providing essential services. They calculated that because of manipulated LIBOR rates, they overpaid approximately $9 million. Money that could have gone to infrastructure, to maintaining water quality, to keeping rates lower for residents. Instead, it went to padding the profits of traders who were texting each other jokes while rigging the system. The Baltimore utility sued. They settled for an undisclosed amount, certainly less than what they lost. And that's one of the successful cases. Thousands of other victims never sued, never got compensated, never even knew they'd been stolen from. You're probably wondering, how did this go on for 7 years without anyone noticing? The answer reveals something deeply broken about financial regulation. First, LIBOR was self-reported. There was no regulator checking if the numbers banks submitted matched reality. The British Bankers Association, a trade group representing the banks themselves, was in charge of overseeing the process. It's like asking criminals to investigate their own crimes. Second, there was an assumption of honesty. Regulators assumed that banks, as respected institutions, would never lie about something so fundamental. That assumption was naive, but it was widely held. The entire system was built on trust. Third, even when red flags appeared, they were ignored. In 2007, a Wall Street Journal article pointed out anomalies in LIBOR submissions. Some banks were consistently reporting rates far lower than what market conditions suggested they should be. The article basically said, "This looks suspicious." Nothing happened. The British Bankers Association issued a statement saying everything was fine. Regulators didn't investigate. The story died. In 2008, during the financial crisis, internal documents show that the Federal Reserve Bank of New York knew something was wrong with LIBOR. Timothy Geithner, who was president of the New York Fed at the time, sent a memo to the Bank of England with suggestions for reforming LIBOR to prevent manipulation. The Bank of England acknowledged the memo, then did nothing meaningful about it. Why? Because investigating LIBOR manipulation during a financial crisis would have revealed that the world's biggest banks were lying about their health. It would have triggered panic. So regulators made a calculated decision to look the other way. Fourth, the manipulation was often small. Traders weren't moving LIBOR by full percentage points. They were moving it by basis points. 1 basis point is 1/100th of 1%. Tiny amounts. But when you're dealing with trillions of dollars in contracts, tiny amounts create enormous profits. Those small movements were easy to hide in the normal volatility of interest rates. Unless you were looking very closely with sophisticated analysis, it just looked like normal market fluctuations. And fifth, the people capable of understanding the manipulation were often the ones benefiting from it. Traders knew. Bank executives knew, or should have known. But they had no incentive to report it. They were making bonuses off these profits. The manipulation only came to light because of a whistleblower. A trader at Barclays, during the investigation into the bank's liquidity during the financial crisis, mentioned in passing that LIBOR submissions were being manipulated. That offhand comment triggered a deeper investigation. Once regulators actually started looking, the evidence was everywhere. Thousands of emails, instant messages, phone recordings. The traders had documented their own crimes in writing because they never thought they'd get caught. When the scandal finally broke in 2012, the consequences were swift and severe. At least, they appeared to be. Barclays was the first to settle, paying $450 million in fines. The CEO, Bob Diamond, resigned. He'd been one of the highest paid bankers in the world. His departure was supposed to signal accountability. Then came UBS, $1.5 billion in fines. Royal Bank of Scotland, $612 million. Deutsche Bank, $2.5 billion. JP Morgan Chase, Citigroup, more fines. By the time the dust settled, banks had paid over $9 billion in penalties to regulators worldwide. Individual traders were charged. Tom Hayes, a trader at UBS and Citigroup, was sentenced to 14 years in prison in the UK, later reduced to 11 years. He was the face of the scandal, portrayed as the mastermind. Several other traders received prison sentences. LIBOR itself was phased out. In 2021, after a transition period, it was officially discontinued and replaced with alternative reference rates based on actual transactions rather than estimates. So justice was served, right? The bad guys paid, the system was fixed, everyone moved on. Not quite. Those $9 billion in fines, they sound massive. But let's put them in context. JP Morgan Chase's revenue in a single year is over $100 billion. These fines were painful, but they weren't existential. And more importantly, they were paid by the bank's shareholders, not by the executives who allowed the manipulation or the traders who executed it. Bob Diamond, the Barclays CEO who resigned in disgrace, he walked away with millions in deferred compensation and stock options. He now runs another investment firm. He's doing fine. Tom Hayes and a handful of other traders went to prison, but many of the traders involved were never charged. They left banking, took their bonuses, and moved on. Some are working at hedge funds today. And here's the really infuriating part. The banks that paid these fines treated them as tax-deductible business expenses. That's right. The penalties for manipulating global interest rates were written off, reducing the bank's tax bills. So taxpayers subsidized the punishment for the crime committed against taxpayers. No senior executives at any major bank went to prison. Not one. The argument was that while manipulation clearly occurred, proving that top executives knew about it and authorized it was legally difficult. So the institutions paid fines. A few traders became scapegoats, and the people at the top faced no consequences. Meanwhile, the victims, those homeowners, municipalities, pension funds, got a fraction of their losses back through settlements. Class action lawsuits resulted in some payouts, but they took years, and the amounts recovered were far less than the actual damages. The Baltimore water utility I mentioned? Even after their settlement, they still lost money overall. Most victims never got anything because they didn't even know they'd been harmed. The LIBOR scandal reveals something crucial about modern finance. It's based on trust in a system where trust isn't verified. Think about how many financial benchmarks still work this way. Prices are set by surveys, by estimates, by self-reporting from the very institutions that profit from those prices. We assume honesty because the alternative, that the entire system could be rigged, is too disturbing to contemplate. But LIBOR proved it could be rigged. Easily, for years, by multiple institutions simultaneously. And LIBOR wasn't unique. In the years following the scandal, other benchmark rates were found to have been manipulated. The foreign exchange market? Rigged. Precious metals prices? Rigged. Energy benchmarks? Rigged. Each time, the same pattern. Traders colluding, regulators failing to detect it until a whistleblower came forward, and banks paying fines without executives facing criminal charges. The LIBOR scandal also revealed the fundamental conflict of interest in how banks operate. The same institution that submits rates for LIBOR has traders betting on where LIBOR will be. That's like letting gamblers set the point spread in a football game they're betting on. The potential for abuse is obvious. After LIBOR, regulators promised reform. Benchmarks would be based on actual transactions, not estimates. Oversight would be stronger. Conflicts of interest would be eliminated. But here's the problem. Finance is complex, and complexity creates opportunities for manipulation. As long as there are massive profits to be made from tiny advantages, people will find ways to game the system. The question isn't whether future manipulation will occur. It's when, and whether we'll catch it faster next time. Some economists argue the entire structure of modern banking needs rethinking. When institutions are too big to fail, they're also too big to prosecute effectively. When executives face no personal liability for their institution's crimes, where's the incentive to enforce ethics? The LIBOR scandal cost the global economy an estimated $176 billion, according to some analyses. Others put it much higher, but only 9 billion was recovered in fines. That's a 5% recovery rate. From a pure cost-benefit analysis, if you're a bank deciding whether to manipulate markets, those odds look pretty good. So, what can you actually do? You can't opt out of the financial system. You can't personally audit whether interest rates are being manipulated, but you're not powerless. First, understand what you're signing. If you're taking out a loan, look at how the interest rate is calculated. Is it fixed or variable? If variable, what's the benchmark? The replacement for LIBOR in the US is SOFR, the Secured Overnight Financing Rate. It's based on actual transactions in the Treasury repo market, which makes it much harder to manipulate. But know what you're agreeing to. Ask your lender to explain in plain English how your rate could change and what it's tied to. If they can't or won't explain it clearly, that's a red flag. Second, favor fixed-rate loans when possible, especially for mortgages. Yes, fixed rates are usually slightly higher than initial variable rates, but that premium is insurance against both rate increases and against any future manipulation of whatever benchmark the variable rate is tied to. Third, diversify your exposure. Don't put all your savings in products tied to a single benchmark rate. Spread your investments across different asset classes. If one benchmark gets manipulated, you're not entirely exposed. Fourth, support regulatory reform. This isn't sexy, but it matters. When legislators propose stronger oversight of financial markets, actually stronger oversight, not lobbied down versions, support it. Write to your representatives. Vote based on their financial regulation records. Fifth, stay informed. Financial scandals happen in the shadows because nobody's paying attention. The more people understand how these systems work, the harder it is for manipulation to go undetected. Share information. Ask questions. Don't accept "it's too complex for regular people to understand" as an answer. And finally, if you were affected by LIBOR manipulation, you might still have legal options. Class action settlements sometimes have extended claim periods. Check if you had a LIBOR-based loan between 2005 and 2012. You might be entitled to compensation. But beyond practical steps, there's a mindset shift that's crucial. Healthy skepticism. The financial industry wants you to trust them. They use words like integrity and fiduciary duty and client first. The LIBOR scandal proved those words are sometimes just marketing. Trust, but verify. And when verification isn't possible because the system is too opaque, demand transparency. Done for you, big boy. That's how casually a trader confirmed he'd manipulate a global interest rate, like he was agreeing to grab coffee. The LIBOR scandal wasn't a hack. It wasn't some sophisticated financial engineering that only PhDs could understand. It was simple fraud, lying, price fixing, cartel behavior. The same crimes we prosecute in any other industry, but when they happen in banking, suddenly it's complicated, it's hard to prove intent, it's difficult to assign individual blame. Billions of dollars were stolen from ordinary people through a conspiracy that was documented in thousands of text messages, emails, and recorded phone calls. And almost nobody went to prison. That should terrify you. Not because of what happened, but because of what it reveals. When the world's most important financial benchmark can be rigged for 7 years. What else is being manipulated right now that we don't know about? The system was supposed to have checks and balances. Regulators, audits, oversight, competition that would expose fraud because exposing your competitor's fraud gives you an advantage. None of it worked. The checks failed. The balances failed. The regulators looked the other way. LIBOR was phased out and replaced. The banks paid their fines. A few traders went to prison. Everyone said the system was fixed. But the people who designed the system, who ran the banks, who made millions while the fraud occurred, they're still there. Still making decisions. Still trusted with your money. The LIBOR scandal wasn't an aberration. It was a revelation. A glimpse behind the curtain at how modern finance actually operates when nobody's watching closely. So what's the takeaway? Financial systems are designed by humans, operated by humans, and humans are capable of extraordinary greed. Every system that relies on honesty without verification is vulnerable. Your mortgage, your loans, your investments are all built on these systems. Understanding how they work, understanding how they can be manipulated, and demanding better oversight isn't paranoia. It's common sense. And the next time a banker tells you to trust them, remember, dude, I owe you big time. Come over one day after work and I'm opening a bottle of Bollinger. That's what trust in banking sometimes looks like. Thanks for watching. If this video made you angry about how the financial system operates, good. Share it. The more people understand what happened with LIBOR, the harder it becomes for banks to get away with similar schemes in the future. Drop a comment telling me if you had a LIBOR-based loan during 2005 to 2012, or if you knew about this scandal before watching this video. I'm genuinely curious how many people are aware this even happened. Hit subscribe if you want more investigations into financial crimes that affected millions, but somehow never became headline news. Next week, we're diving into payment for order flow and how free stock trading apps might actually be costing you money. Stay skeptical out there.